Welcome in, YouTubers. I'm Tony Mendes. Today we're talking about when to refinance your adjustable rate mortgage. Thanks for joining us today. You can always subscribe to our videos right here, and you can always set up an appointment with us at Calendly link right here. Today we are talking about when to refinance your adjustable rate mortgage. It's part 4 of a series of 7 videos on when to refinance. Again, I'm Tony Mendes. I'm a mortgage expert. I've been in the business for over 17 years, host of the Real Estate Report radio show. So what is an ARM? An ARM is an adjustable rate mortgage, which means that after a fixed rate period, which is one of the features of the loan, could be 3, 5, 7, or 10 years, your rate will adjust, which means your payment will adjust. And a lot of people fear that that's going to go up. In many cases, it does. So let's talk about some of the components of an ARM real quick before we talk about some of the examples of when to refinance. So an ARM has an index and a margin. The combination of those two equals your rate. The margin never changes. That's the profit that the lender makes. And the index is the underlying rate that that follows the economy. All right. So if the economy is getting better, the rates go up. Your future rate adjustment will go up. So then there's something called an initial rate cap. So after, let's say, example that you had a 5-year ARM, it's fixed for 5 years. Your 61st payment has a cap on how high it can go. It's usually 5%. Yes, it's pretty large. Then every year after that, it can go up 1 or 2%. And then there's something called a max cap or life cap, and that's usually 5%. So yes, there can be real large adjustments in your interest rate when it starts adjusting based on the index and the margin. So be very careful about being sold that fixed rate period. A lot of people, they got sold on, hey, you can get 2.75% on this, and 30-year fixed at 3.5. Why are you wasting money? Get the ARM. But they were sold also on that index and margin. They said that the margin won't change, and the index, it won't change that much. It can change a lot. Right now, we've seen indexes rise up almost a half a point to a whole point just in the last 12 months. So when you combine those and you get a higher interest rate, then your payments go higher. Not only is your rate going higher, but you're also amortizing for a shorter period of time as opposed to refinancing. That's another advantage of refinancing. So those are the cons of the ARM, is that you end up with a riskier loan. It's confusing in many cases. It's not sold properly, and it might not fit your time frame. And it can be costly because then you end up refinancing, and there's costs associated with a refinance. Some of the pros for an ARM is you can fit because it has a fixed period and the rate is lower than a 30-year fixed, you can fit that time frame, that fixed period, over a time frame in which you are going to keep that property. Let's say that you're going to be in your property for 7 years, and you get a 7-year ARM. Why would you get a 30-year fixed at a 0.75% on average, higher than the ARM, and spend more money over that same period of time? You end up with a lower balance. You'll save money along the way, and you're going to sell the house and move it somewhere else, and maybe you get another ARM. ARMs have a purpose as long as they're used right and sold to you properly, where you have the proper expectations of it. Let's take an example of a $500,000 loan at 2.75% on a 5-year ARM. So you're fixed for 5 years at 2.75. You're enjoying the lower rate. But at the 61st payment, what's going to happen? Well, you have an index, and then you have a margin. The margin, let's say it's 2.5, and the original index was 1. But let's say that went up to 2%. Now the combination of those two is 4.5%. And you have a 2% cap. So you're falling under that. So 4.5% will be your new rate. So your original payment was $2,041, but your new payment at 4.5 will be $2,459. So you're $418 higher each month. So you have to decide, are you going to refinance? Yeah, probably. Even if the rate goes up 1.25%, you're going to re-amortize, and the rate's lower than that adjustment, and you're fixed for another period of time, whether you get a 30-year fixed, or to confuse you even more, you can get another ARM. A lot of people that get ARMs get kind of tied into these ARMs based on economic conditions. So the new payment at 4% is $2,124. So yet it's a little bit higher than what you had. It's much lower than what it will be if you don't do anything. So that's the basic philosophy behind using an ARM, or refinancing out of an ARM, is to hedge against future rate hikes. It doesn't mean you have to get a 30-year fixed. A lot of people in ARMs got bit really hard, and they just said, you know what, I'm never going to use an ARM again, when indeed they can help you. We're seeing more and more ARMs being used now as we see rates go up. And it's important to know that those time when that time frame is over, that fixed rate period, that you can have large adjustments. So you have to be prepared to know what to do. And I think that's where a lot of people got stuck with ARMs, at least the adversity to them. So you're welcome to learn more about this by going to our website, bayarealoansource.com. You can always set up a schedule with us at our Calendly link, and you can also subscribe for some of our new videos. Thanks for joining us today.